Hey guys, Freaky Finance here. Last week we looked at Quisitive on the AI space, and this week we're also going to stay in Canada, but we're going to look at the gold space. This video is a little bit different, as it's one that I'm currently contemplating whether I should keep riding it out or if I should take some profits and go into other things. So I think I've done a couple copper videos by now, and I think I've done at least one gold video. I'm more of a copper person over time, especially for the next decade, really, at least. Just based on outlook, I just think there's a lack of new supply coming on in the back half of this 2025, 2026, 2027, 2028, 2029, and 2030, as well as the demand, obviously, from the renewable shift. Because you have, just say, for example, aside from EVs alone, just using more copper than traditional ICE combustion engine vehicles. You have even just say the switch from oil to or not even oil, but from coal's a good example, to natural gas. That takes 50% more copper per kilowatt generated. But then you have things like solar, which is about double copper required. Then you have things like offshore wind, which takes about 5 times the copper required for the energy generated. So that's kind of how I view things over time, and the more of this renewable push, the more it supports copper over time. And that's why I like copper. So, but I kind of went on a tangent here for today's video, but I'm just trying to link that in. So one of the things I like to do, I'll show the positions first, is I highlighted the ones that are more in the mining space. So I got Argonaut, Caliber, Capstone. I did a video on Capstone, I remember. I did one on Freeport, I remember. And I got Ivanhoe. And I'm basically waiting for the copper guys to get cheaper, and I've been waiting for a while, and I try to take stabs when they get cheaper. So far they haven't stayed cheap for too long. Copper actually hasn't corrected as much as I hoped it would in 2023, even despite a relatively weak economy. The inventory is just very tight, probably again because of lack of supply. And then obviously high generative areas such as Chile and Peru keep putting capex to work difficult to generate a return, so it supports the price over time, which likely means I'm not going to get the pullback I want in some of these. But anyway, I'm still being patient. Today's video isn't on copper though, it's on a gold miner. It's appreciated quite a bit, and we'll go into the written reasons why I got in it. One of the things I like to do with miners is right before a production ramp, I like to look at them and see where they're priced at and whether I think the production ramp is priced in or not. This one had a very interesting thing because it had to issue equity, a lot of equity, we'll go into it, at a material discount to its current trading price. So basically it burned all the existing investors to get this project done. It is a big project for them, and it's going to be the crux of this video. So basically it burned all the existing investors to get this project done. And so I saw it and I thought, okay, this company basically spent $1 billion on this mine, and now the company's worth less than $1 billion it just put up, even though it owns all these other things. So I was like, okay, I'm just going to buy it, and I think it'll go up over time. And now it's kind of played out, and that's why I bought it. Now I'm forced with the decision whether I should take some proceeds off or not. So it's a fun one. So let's jump to it. So really, part of operations are concerned, we have the one mine that I'm interested in. So that's your Magino Mine in Canada. And then you have Florida Canyon, and then 3 at Mexico. The purpose of today's video is just going to be on this mine, because that's the catalyst, the reason why I'm in it, and the reason why I got the deal I did when it panicked, when the share price collapsed, really. One of the reasons why is, according to them, it has the potential to be one of the largest and lowest cost gold mines in Canada. Whether that's true or not, I don't know. That's what they say here in their 10K, or 10Q rather. Now there is a couple things here, and maybe we'll talk about this at the end, is that where it's located is around a lot of other miners that are a lot bigger and have a lot better access to capital. One of the reasons why the share price collapsed on these guys is because liquidity dried up for them, and so they were forced to issue debt at a fairly high floating rate, as well as issue a lot of shares at the same time where the equity markets are very weak. Basically, larger companies have more access to capital. So when I look at companies, say like a Barrick, obviously a big company, or Newmont, or say even things like Alamos, they're all bigger and they're all around these guys, and I'm surprised. One of the things I'm thinking, and why I'm kind of more hesitant to sell, I think it's very likely once these guys actually get to commercial production, that one of these neighbors buys them out after they do all the hard work, because the valuation is less than what it costs them to build the mine out. So that's what I'm thinking, and so I'm trying to, should I just sell now because I'm up enough, or should I ride it out for a takeover? And so it makes it tough. So where is this main mine? It's Ontario. It's actually just north of Sault Ste. Marie. The Americans is north of Michigan and east of Thunder Bay. So, and it is neighbored by Alamos, pretty close there. And anyway, the address on what I could find was on this Goudreau Road somewhere. Unfortunately, Google Street Maps doesn't have into these random little lake areas. Ontario has a lot of little trails and lakes, especially on this rural side. A lot of people think Ontario is Toronto, but there's a lot of lakes in Ontario. Anyway, project, it's what you expect. It's the one thing that's nice about miners is that the operations themselves can vary, but it usually has the same risks. The differences are usually political or royalties and labor laws and taxes and stuff like that. But one of the things that's nice is that we finally have the first pour. That was in June. So now that it's partially de-risked, they can't go over run again. They can't delay their timing again. It's finally there, right? So we're actually starting to see, or we should see, more results. We did see some results, some production, but we're going to see more in the next quarters and into 2024. Importantly, 2022 was very bad for this company. we'll jump into it really quick, but also, before I get deeper into it, the grades here you can see for this Ontario mine are actually far greater than Florida Canyon, as well as the Mexican mines. So it is a fairly good mine in a fairly, what I would say, a good location in terms of political risk and stuff like that. Though ultimately Canada is generally more expensive to mine in terms of a labor type of thing. Here you can see the production profile. So it's been in decline for quite some time, especially on the Mexican side. And then we finally started seeing something from Ontario. It started just in the middle of June. So we only really had half a month. But we should see this tick up finally, and that's what I'm hoping is like a 15 to 20% production growth in 2024 or 2023, especially at a mine that has a better grade. So the all-in sustaining cost, the ASIC should go down. We talked about that before. Production ramp ASICs go down, as well as because the grade supports that as well in terms of the sales mix for the overall company. So we have quite a decent margin expansion story here finally for these guys. Finally there. Though it cost them more than an arm and a leg. It probably cost them the company in the long run. But anyway, so the guidance, they're basically saying they're going to do 72 to 81. Longer term, they think they can get up to 200 in a year. So it's a pretty good mine. Cash costs are A6 are fairly low for Canada. Again, that usually derives from the grade. And for reference, why do I think it's good? Well, because of the numbers I just put up last year were so horrible. And in the year before, they were both very horrible. Even on an annual basis, they're only at 1,300 in 2021 and almost 1,800 in 2022. So very bad 2022 that we're comping against for the rest of this 2023 year. Anyway, it's definitely going to start looking better year over year anyway from a comparison basis. That's what I'm trying to say. The share price got destroyed during 2022. And you can see especially in this June period, just collapse. This thing was started the year off even on a collapse. I mean, at one point it was at almost $4. But anyway, this thing, just to say, enters the year around 2 and then gets blown out in the middle of the year all the way down to 40 cents. And then it kind of sat here, and I remember looking at it, and eventually I pulled the trigger. I actually got a very lucky fill. It's recently traded back up to about 65 cents, but it's still under $1. And it's under what it cost to make this mine. Anyway, here's the news release during June 2022 when it collapsed. They issued 434 million shares at 45 cents. And for record, when we go here, I find this fun, is when we go, so this is the history of the shares outstanding at the bottom. So you guys can see it, I'm not in the way. But anyway, it was at 155 million. During 2022, you can see it was at 311, 333-ish. And then basically this thing shoots up. You can't see it, I'm in the way. But this thing shoots up to 700. Like it's 743 million. And now there's 838 million shares outstanding. So we're talking severe dilution. So basically, they took any existing shareholders and diluted them materially in 2022. So I saw that and I was like, oh, geez. And then the results as well in 2022 were very, very bad. They're still very bad right now for 2023 so far, but I think with the beginning of the pour in June of 2023, we should see July and August and September pick up for Q3. So anyway, financially, normally I'd do my own little workbook, but because the backwards looking numbers are so bad, there's no point. I'm not really investing in, but I think I'm getting a good buy here. I'm more thinking about whether I should just walk away with the proceeds, and that's always a tougher decision for me. I have an easier time getting in than I do getting out, personally. But anyway, balance sheet, you can see the debt has ticked up. That's also what was required. So not only did they issue shares, they also borrowed, and the borrow is actually quite high. I guess first let's talk about the assets. So you can see this pretty big $1.2 billion in PPE. When we go to note 8, you can see that quite a lot of this 1.1 is actually generated from $975 million in assets under construction. Now, this company, let's call it maybe the equity right now is worth $560 million or something. And it has, we'll just call it like it is, $200 million in debt, right? More than that, $250 million in debt. So anyway, just call it worth 900 million or 800 million, whatever you want to call it. But you can see that they've actually poured in 975 million in capital into this project already. So the current valuation, even after it's rallied, the current valuation is still less than what they've put into this one project, let alone the other mines that are whatever, they're okay. Nothing special. So that's why I'm like, okay, should I stay in? Because I think someone could buy this, right? And because their cost of capital isn't crap like this company's cost of capital is, because this company, not their fault, they're just a small company that got hit at the wrong time, I would argue. But perhaps they should have seen it coming, or perhaps they should have been able to partner with somebody to help them offset some of the dilution, especially when they're neighboring with so many bigger billion-dollar gold miners just around their little area for that mine. But anyway, that's why it looks interesting to me. On the cash flow statement, you can see that the company has been in heavy capex investment mode for quite some time. Again, that's the Ontario mine, and they've also been drawing down debt to pay for it, as well as issuing shares. So money has to come from somewhere, and it came from both investors and debtors. And you can see the shares outstanding. I already talked about how it shot up even more than this. This was just at the end of 2022. In terms of the debt, it's also not good. You can see that they have the 6% floaters. So it's the overnight rate plus the 6%. So whether it's 5 plus 6 right now, I'm not sure. But it's going to be a high amount for these guys. So the cost of their debt is very high relative to, say, something like a Barrick, which could be materially less than this because they have better access to capital markets. So again, that's another reason why I think this company is just waiting to get acquired by somebody. Only after though, that the company does all the hard work by actually getting the production up. But that's what I'm thinking, and that's why I'm struggling with letting go of the company and moving on and using proceeds for something else. They also do have the converts here on the debt side, but they convert at 286 per share, so it's a far cry from where they are now at only 65 cents or something like that. Yeah, I think they closed around 65 anyway. And then in terms of like who's around them, like we've seen Alamos, who's right beside them on this mine, just doing fine, so they could have no problem taking this company over if they wanted to. Just using the relative share price outperformance, they would probably make money here. And then even Barrick, just if they decided to leverage and $1 billion and buy them, right? It would be small for these guys. And maybe they just want that one mine and then they just sell off the rest or find someone else to take the rest off their hands. But anyway, that's what I'm thinking. And again, the priority here isn't to pay down the debt once they get to their commercial production. They put this at the top. So they want to develop the good mine more. So that tells me that they're probably thinking about selling, or at least that's what I'm conjecturing. Because the debt is so high. I mean, that's 6% plus, right? It's got to be around 10 to 11% for these guys. Anyways, in terms of the call, it's pretty short. There's nothing there. That's just them saying, yeah, we got to final first gold pour mid-June on this mine. So in terms of execution risk, it's finally behind us. And then in terms of the Q&A, I just like when they're like, we'd like to turn the call over to questions, and then the operator's like, oh, there's no more questions because there isn't any to begin with. It's kind of funny. It tells you no one's interested in this company anymore. All the investors got burned. No one cares. So I like that as well. It kind of tells me that I want to stay in it. And then they did say that they're going to start putting the high grades material through the mill this week. And at this time, this is the middle of August. So that's why I'm thinking Q3 should inflect positive for these guys and actually show year-over-year EBITDA growth for the first time in a while. So you can see I'm kind of torn on this one, but it's a fun one to review anyway. It can be a shorter video. Anyway, I'd like to know your thoughts. I'm kind of more on the copper side, but I like these setups when the gold miners get smacked by something like access to capital. There's an emotional response. I look at it and I say, if there's something obvious, like they've already put in more cash capital into this mine than what the current entire company's worth, that's when I start getting excited. And you have to remember that was almost 80% cheaper than it was now in terms of equity. So it was even more obvious back then. Anyway, I'd like to know your guys' thoughts, or if there's any copper miners out there that you guys are excited about, specifically ones that have good production cadence into the back half of this decade. Anyway, have a great rest of your weekend.